Hello, greetings, and welcome to Dividend Blasters. This is our 38th video, and the topic today is dividend investors. This is why I invest in Costco, ticker symbol COST. I've been a customer and a member of Costco Wholesale for about 28 years. I'm a happy customer. I love going to Costco because I know that I'm getting good value. More recently, last couple of years, I have been an investor in Costco, and again, couldn't be happier. There is a lot of good stuff to talk about Costco. So what I'm going to do is I'm going to tell you what I know about Costco. As a customer and as an investor, I'm going to start out with some basic history, some of their business operations information, and then I'm going to go into some of the investment info nuggets that I feel are interesting and will be useful to you as an investor and as a dividend investor. All right, let's press on. And before we do, a quick disclaimer. I am not your financial advisor. The purpose of this video is for information and financial education. It reflects my own personal opinions. It reflects my experience as a customer of Costco as well as an investor. And I have been an investor not just in Costco, but in other equities for the better part of more than 30 years. But I urge you, do your own research, do your own due diligence, consult a financial advisor prior to making key financial investment decisions. All right, let's move on. I will kindly ask if you could give us a like and subscribe to our channel. It helps the channel, Dividend Blasters, and share the video with a family member if you think they'll find it interesting and useful. All right. So, what is Costco? Costco is an American multinational corporation, and it operates a chain of membership only big box retail stores. It's a club, it's a warehouse club. It's a great business model. So, they are making money before you even step in the door. You have to pay an annual fee, become a member, then you gain admission, and you can get lots of great deals. As of 2022, they're the fifth largest retailer in the world. They're the world's largest retailer of choice and prime beef, organic foods, rotisserie chicken, and wine as of 2016. They're a member of the Fortune 500. They're ranked number 11 by total revenue. Their global headquarters is in Washington State in a town called Issaquah, a suburb of Seattle. They opened their first warehouse in Seattle in 1983 through mergers and acquisitions. They go back to 1976, where their former competitor, Price Club, was founded in San Diego. So they have over 848 warehouses. The lion's share of them are in the US, 584. They have warehouses in Canada, Mexico, Japan, the United Kingdom, Korea, South Korea, that is, Taiwan, Australia. They have a handful in Spain. They have a couple in France and China. And they got one in Iceland, New Zealand, and Sweden. Just a little bit of commentary. This is a company that is continuing to grow. I'm going to talk a little bit about this when I give you a comparative look at how they stack up against their peers. This company is big and they are still growing, and their peers are not growing like they are. And I'm going to get into that a little bit more later. Hang tight. But now, just some corporate facts, and I got these from their websites. Here's the number of warehouses. So, and I mentioned that in 2022 they had 848 warehouses. Now they have 853. This is just as of last week. So, as I mentioned, they're continuing to grow. You can see the breakdown by geography. The number of members is over 124 million cardholders. You can see the square footage of their warehouses. It ranges from 80,000 to 230,000 square feet, which is pretty big. Revenues over 222 billion. Wow. Over 203,000 employees, full time 304,000 full and part time. That's a lot of people, folks. So, summary metrics. This stock is not cheap. You will pay 512.59 a share. That was its closing price as of last Friday, June 2nd. I like the earnings per share. It's 14.46. They're easily covering that dividend, the forward dividend of $4.08 annually. And it's a quarterly dividend company. So you're going to get about $1.02 a quarter for every share you have. That yield is modest. It's 0.8%. It's like a Microsoft yield, essentially. But they do make up for it with the cagr. And I'm going to talk about that. That dividend growth rate is something to write home about. You can take a look at the PE ratio, and the PE ratio, I believe, is a little bit high compared to their peers, as well as, of course, the S&P 500. The PE ratio is over 35. Some people think that Costco is a highly priced, maybe overpriced stock. I'm telling you, I think, yeah, you can ask that question, but the growth of this company astounds me. And I am an investor and I'm continuing to invest in it because I think that the price is justified. The Dow Jones P&E is about 22 and a half. So it's about 12 above the Dow Jones. The S&P 500 is about 18.7. So it's almost double the S&P 500. So some people think it's high, but I'm telling you, I just don't see it abating. I think it's going to keep going. All right, let's keep going here. So let's take a look at performance. So price performance over the last 25 years has been almost 5,000%. That is, something to write home about. The total return, which is price appreciation and dividends, is again almost 5,000%. So, I am a dividend investor, but I'm also a growth investor. You're going to get more bang out of growth than you are out of dividend. But you know what? Every time you get a little bit of dividend, you get a little bit of drip, your average price investment comes down. And that's what I like about being a dividend investor. And I am dripping 100% into my Costco holdings. So here's the dividend summary. You can see the grades, the yield they get, and this comes from Seeking Alpha. They give it a failing grade on yield. I can't disagree with that. But what I like the dividend safety and I like that growth rate. That growth rate is wonderful. And if you take a look at the bottom panel, first row, the 5-year CAGR is 12.44%. The yield's 0.8%. The CAGR is 12.44. And as I've mentioned in other videos, I like to see uh, an investment have a threshold of at least 10% between the yield and the growth rate. Well, here it is 13.64%. I think that's pretty good. It is a very consistent dividend. It's a safe dividend. And how do I know that? It's safe because the payout ratio is 26%. It's nowhere near that 60% uh, figure, which we don't like to breach. And the payout ratio is 26%. So it's the ratio of dividends paid out um, over earnings. So it's safe. And it's consistent because look at that growth duration of 18 consecutive years. They're raising their dividend 18 years and counting. They are 7 years away from being a dividend aristocrat. All right. So I'm making the point that these guys are committed to paying out a growing dividend. They start modest, but as I've pointed out in previous briefings, it's the cagr that really makes the difference. And as that cagr takes hold and it begins to snowball your holdings, it really makes a difference. So here's a little bit more of a deeper dive of the dividend growth rate. I talked about the CAGR. It's 12.44% for 5 years. The 10-year CAGR is 12.96%. So it's continuing to grow. I like that revenue growth, forward revenue growth of 9%. Uh, this is a company that is growing. And you can see that, take a look at the sector median. So their competitors in the sector, their median, the average of the median, or the median, is less than Costco. When you look at not necessarily the yield, but it's the growth rate, the dividend growth rate, and the revenue growth rate. I talked about the 18 years. The sector median for continued increasing dividends is only 2. So here are their peers and competitors that I get out of Seeking Alpha. The key ones are Target, Walmart, Dollar General, and Dollar Tree. Well, the only one that is bigger on market cap is Walmart, but you're going to see that they're not growing like Costco. They have 7 times as many employees. Their market cap is less than double, almost double, but they have 7 times as many employees as Costco. Uh, Target has more employees, yet their market cap is about a third, less than a third of Costco's. Dollar General, forget about it, as well as Dollar Tree, much smaller. To give you some context around trading price, uh, Costco is trading at a higher price, 512.59 as of last Friday, June 2nd. Target is about a quarter of that, as is Walmart, as is Dollar General, as is Dollar Tree. They're all in the 100s range. And I think it's just the market that is pricing Costco is a better investment. That's how I look at it. This is not financial advice. This is financial education. All right. So let me go back and get on the right slide here. Total return for 10 years, and this is a graduated look from 1 month to 10 years. Well, 10 years, let's look at that. 468% for Costco. We already looked at the max time horizon, it's almost 5,000. But for 10 years, it's about 468%. The only one that's marginally close is Dollar General, and that's about half. All the others are less. 5 years, about half or less. 3 years, much less. Dollar General's negative at 3 years. 1 year, they're all almost negative, except Costco. Walmart is not bad at 3 years. They're actually beating Costco. But as a dividend investor, I'm looking at that longer time horizon. Year to date, I mean, 3 of them are negative. And 2020 with 2022 and the beginning of 2023 has been rough. A lot of companies have lost, but Costco is almost 13%. So that's pretty good. Target is negative, and Walmart is less than 6%. Dollar General minus 32%. Dollar Tree minus 5.54%. So I mean, on price return and on total return, um, it's Costco. And again, when we say total return, it's price plus dividends. And here is dividends. Well, you know what? I got to say one thing. Target and Walmart are dividend kings. Well, Target is. Walmart will be. They're 1 year away from being a dividend king. And I'm looking at the consecutive years of dividend growth. That should grab your attention. Costco is phenomenal. 18 years, they're going to be an aristocrat in 7 years. Target is already a king. They've been doing it for 54 years. That says something. Walmart, 49 years, they will be a king. All right. These are absolutely good dividend investments. But you know what? As a dividend investor with scarce investment dollars, I am looking for the very best investment to put my money. So, dividend yield, I mentioned that Costco has a modest yield. All right. They all have better yields. All right. But let's take a look at the payout ratio. The payout ratio is safer with Costco. It's 26%. The other two, Target has a 70% payout ratio. I think that's kind of high. I do not like to go above 60%. Walmart's not bad, 34%. That's completely safe. We do not know what it is for Dollar General or Dollar Tree. Let's look at those CAGRs. Well, I do love that CAGR for Costco. It's 12.44%. Targets is good. They're growing it. But with that high payout ratio, I'm going to ask, can they maintain it? The payout ratio for Walmart, no, not even 2%. For Dollar General, it's good. It's good. It's 16%. But again, I don't know what the payout ratio is. So I'm kind of leaning, on this dividend grade. I like Costco, and I tell you, I don't know that I would go with Target until I know more. I don't like that payout ratio. Walmart's payout ratio is fine, but that growth rate is just for dividends is not something that I'm excited about. I do know what I'm getting with Costco, so that's why I have Costco. But there's more information. Let's look at how Seeking Alpha rates them. Well, we know that they're going to give them a failing grade for yield, but look at dividend safety, A plus, dividend growth, A, dividend consistency, A. Target gets good grades, but I'm telling you, dividend growth, they're getting a B plus. I'm not sure why, and I'm not sure why Walmart's getting an A minus for dividend growth. I just don't see it. So I'm not sure I agree with that. But anyway, you can look at this, you can research it, but I'm giving you my assessment right now of these on a dividend perspective. When you look at valuation, okay, I do know that they have a higher PE than everyone else. But I'm telling you, Costco is growing faster. So look at the PE. Costco's is at 35.86, the forward PE ratio. Target's is a little under 16. Walmart's is 27. You can basically see that Dollar General's is 16. Dollar Tree is 27. You can take a look at that. And then you can look at the other price ratios, like the price to book, the price to cash flow. Theirs is a little bit higher. It's a little bit closer in price to book. Price to cash flow, it's still kind of high. Okay, but it's closer. Growth. Now, I really believe that this is where they separate themselves. Look at the revenue growth for Costco year over year, 11.5%. Target's not even close. Walmart is way behind. Dollar General, they're close. They're in the game. Dollar Tree is way behind. Let's look at revenue 5-year compounded growth. Well, 11.5% for Costco. Target, 8.3. Walmart is about a third. Dollar General, 10%. Not bad, but not as much. Dollar Tree, about half, 5%. Let's look at net income. 3-year CAGR. Costco, 17%. Target is negative. Walmart is really negative. Dollar General, 12.15%. That's not bad. Dollar Tree is better, 19.54%. But when you look at all these measures, you can't just look at one and say, aha, that's what I'm investing in. You got to look at all of them. You got to look at them holistically, and you got to make a decision. Okay. How about levered free cash flow for 3 years? Costco is above and beyond everyone else at 10.3%. Walmart, a little under 8%. Dollar Tree, minus 40%. Wow. Total assets for 3 years, they're way ahead, 11%. Target, 5%. Walmart, 1.7%. Dollar General, not bad, 8.4%. Dollar Tree, about a third of that. All right. So, there is a theme here. Uh, Costco doesn't win on every single metric, but consistently they are winning on most of them. So we look at the gross profit margin. That doesn't tell the full story. Okay. I mean, they're all have a higher gross profit margin, but I'd like to look at some of the others. Net income margin, it's closer. They're 2.58% more than Target and Walmart. Dollar General has a higher margin at the net income level, as does Dollar Tree. Return on equity, it's much different. It's mixed. They have almost 28% more than Target, double Walmart's. Dollar General, almost 41%. Okay, so that says something about Dollar General. Dollar Tree, a little more than half of Costco's. They're at 16%. Return on total capital, forget about it. Costco is far and away number one, 16%. All the rest of them are around half or less. Cash from operations, well, 9.5 billion, that's quite a bit. It's more than everybody's, but look at Walmart. And again, remember, Walmart is a much bigger company. They have many more employees, so a lot more operations. Their cash flow from operations is about three and a half times the size, 37 billion. Now, what I like to look at is I always like to look at net income per employee. Walmart has six times as many employees as Costco. Net income per employee for Costco, 19,900. Target, 6,100. Walmart, the big boy, 5,380. Dollar General, 14,211. That's kind of close, but about a third behind. And about half is Dollar Tree. So I do still like my Costco. Price performance, I'd say forget about it. It's Costco. And you can look at this graduated from 1 month to 10 years. 10 years stands out. They are far and away number one. They are growing. Why is their price performance growing? Because people are watching it and they're reading about the continued expansion. And I mentioned that the number of houses increased by five or six from the end of last year to the first 5 months of this year. So they continue to grow. Risk, this is a safe investment. Look at those betas. The 24-month beta is a little over 1.0. And remember, 1.0 is price volatility for the S&P 500. They're 1.02. They're all about the same. Okay, all of these are not really volatile investments. But what we are seeing with Costco is that it is growing and the price is pushing upward. All right. Income statement and balance sheet measures. I'm not going to go through all of these, but for context purposes, you can see how Costco stacks up against its peers. Walmart, their revenue is, more than double, triple almost, because they're just so much bigger. Their net income is less than double, but almost double. And their operating income is about three times as much. So they're a bigger company. Balance sheet, well, let's take a look at the balance sheet. Um, I do like the fact that Costco has more cash than anybody here, including Walmart. The cash per share is seven or eight times more for Costco than it is for Walmart and everybody else. The debt is about 9 billion for Costco. For Walmart, it's over, looks like more than 60 billion. It's huge. All right. Debt to equity, 40% for Walmart. I'm sorry, for Costco. For Walmart, almost 78%. For Target, wow, over 162%. For Dollar General, over 318%. Over for Dollar Tree, over 114%. Those debt levels are high, in my judgment. The only one that I am comfortable with is Costco. I'm comfortable with Walmart's, but there are other reasons why Walmart gives me pause. I don't think they're growing like Costco. You can look at the current ratio and the quick ratio and the covered ratio at your leisure. Um, I'd say that the total long-term debt over total capital, that is a favorable ratio of 26% for Costco. Walmart's is not bad, 38%. The others are much higher. You're getting in the 40, 60, 70% range. Cash flow, I talked about cash on hand or cash balance. This is really more cash flow from operations or net operating cash flow. I did talk a little bit how they're a little under 10 billion. Walmart, the much bigger company, they're at 37 billion, but their cash is probably going towards some of those capital expenditures as well as some of the debt that they have. So something to think about. Costco has a much better cash flow than Target. Target is not bad for their size, but Dollar General and Dollar Tree much smaller. All right, folks. So, what are the key takeaways? Well, as I mentioned at the beginning, Costco is the fifth largest retailer in the world. They're ranked 11 on the Fortune 500 of the largest U.S. corporations by revenue. As of February 2023, they had 848 warehouses in worldwide, 848 worldwide, 584 in the United States. They're growing faster than their competitors. We talked about that. The revenue growth, the dividend, CAGR is phenomenal. Total returns have been higher than their peers and their competitors. They have a higher PE ratio, okay, but their net income, their earnings, their total return, their price return, their return on assets, and return on total capital are higher. They have a modest dividend yield, but the cash flow and the dividend CAGR are just superb. That's why I am an investor. So, folks, that's all I have. I do hope you found this to be informative and you got some enjoyment out of this discussion, and it'll help inform you as you make a decision. I would kindly ask again if you'd give us a like and a subscribe and share the video with a friend or a family member. Until our next video, have a wonderful day and God bless.